Hi and welcome to today's presentation. I'm Chris Sharkey, the owner of Property Aggregators, and I'd like to tell you a little bit about us before we get started. I've been in the property and finance industry for over 12 years now and helped many clients work through their situation and done many property investment analysis for clients. So I can assure you we have industry experience. Let me just give a bit of disclaimer. Anything I say today, I want you to realize that for anyone attending today, that this presentation, you should always seek personal professional advice relevant to your own personal circumstances. It's very important. Why we're not accountants, we're not financial planners. It's always important to get the right advice for you around your current situation. Um, just a little bit more about us. We have a combined 20 years experience among us. I have people who work with me combining their experience and mine. We have over actually 20 years experience in the industry. We've helped many clients achieve their financial goals when it comes to investing in property. We understand the investment process because we've been around so long. We understand the whole process from beginning to end. And what that does for a client, it reduces their stress because they will face hurdles, and we can reduce that stress and those hurdles for the client. And also we guarantee we're going to be there with the client, with you through every step of the process. What makes us different? Well, we're different because our combined knowledge gives us clarity when it comes to helping solve our client's financial position. So when it comes down to it, we need to get a clear understanding of what's happening in your financial situation. And we have a combined knowledge together. And by having that knowledge, we can help you solve what you need to do in your financial situation. Also, quality when it comes to service. We will call you back. We will get back to you. Very important. A lot of clients often feel like they're neglected and they don't get listened to. We do our research. So anything we present to you, we're going to do research on that particular investment. And we're going to make sure we have all the investments. So you have, and why it is because we want you to make an informed, intelligent, unemotional decision when it comes to this. And knowledge gives you a bit of a sense of security. We try to maximize the return, so it reduces the risk. That's very important. And we provide a cash flow analysis on each property for the client. So let's look at some considerations here. Debt. Now there's two types of debt that people have. There's non-deductible debt and deductible debt, and let me explain them to you. Non-deductible debt is the debt like your home, your own home, credit cards, car loans, store cards, etc. They're non-deductible debt. You can claim nothing from them. And then there is deductible debt. Deductible debt is any debt that you accrue through investing, which is very important. So when it comes to your debt, you need to get rid of the non-deductible debt first. Very important. And we explain that when we talk about the structure. You also got to look at what is your combined household income. Why is that? Because reducing your tax is very important. Why give it to the tax department if they've given you a way that you don't have to give it to them? Why would you keep giving it to them if there was a way to use that money to put towards an investment? And then you've got to consider your retirement. Where are you at? You've got your super, but will that be enough? So there are things we need to look at to get you into a financial position for retirement. So we look at the 20 rule. What does that mean? Let's have a look. So what we need to do is take an income that you would like. So if you were to retire tomorrow, what would you like to have regularly coming in on a yearly basis so that you can live comfortably. If you owned everything, you owned your car, you owned your house, what income would you need? So let's have a look at it. So let's say you wanted to have $60,000 a year to live on. That means you've got to have $1.2 million worth of income sitting in an account that you can draw on for the next 20 years. So if you were to look at where you are today and you keep doing what you're doing, where will you be at retirement? Will you have enough to provide a retirement income? You see, before many years ago, the pension was set up because people retired at 60, 65, lived for 3 years and then died. Now we're living 20 years in retirement. So we need to consider that. How can you do this? How am I going to achieve $1.2 million by my retirement? Well, let's have a look at it. There's two things you could do. So, for instance, if you had 20 years to retirement, option one is you can put $700 a week in the bank. If you were lucky enough to get 5%, you put it in there for 20 years, consistently putting in there, never touching it, it'll give you 1.2 million. Now, let me ask you, could you afford to put $700 a week away into a fund and then trying to find that 5%? Could you do that? So what's the other option? What's the other option? Well, you can invest in property. How? Well, that reduces my debt, and we show you how to structure it to get that debt down. It can reduce your tax. Why? Because you're getting tax deductions, and it can increase your wealth over time. So the question you need to ask yourself is this. Now, remembering you need to put $700 a week away for the next 20 years to reach that 1.2 million, or if you were to buy an investment property tomorrow, and it could help you to reduce your debt, reduce your tax, and increase your wealth, how much could you really comfortably afford on a weekly basis to put towards that property? $50, $100? So let's say $50 a week. We found a property. It was only going to cost you $50 a week out of pocket after we do the analysis, looking at the rental income, the tax income from the tax department that you're going to get because of your tax deductions, and it was only going to cost you $50 a week. I'm sure you'd look at it, wouldn't you? Of course you would. Rather than putting $700 a week away, you can now put $50 a week, because any capital growth that happens on that property, or we pay it down over time, that gives you consistent rental income or gives you good capital growth. So why property? Why do we recommend property? And in there you can see new. And there's a few reasons why we look at property, and we also consider new property. You have two partners helping to pay for the property. You have the tenant and the taxman. What do I mean by that? Well, you're getting rent. You're getting tax deductions, which reduces the amount of tax you've got to pay the tax department. That money comes back to you, and you can put that towards the investment property. So you've got two partners helping you pay for this property. Property is historically sound. Property's always been a historically sound investment, and we have historical data that can help you with that. You get greater tax depreciation. Now, this is talking about new property now. You get greater tax depreciation because you get tax depreciation on the build for up to 40 years, and you get a tax deduction on the fittings and fixtures as well. Also, too, the new property tend to attract quality tenants. The reason for that, they're in good locations. And they're also brand new, which attract a higher rent, which attracts a better quality of tenant. And not being discriminative, but we do need to look at the type of tenants that we're going to attract into our property. They're also full turnkey, the new properties we recommend. Do you have to do new? Not at all. But we recommend it, considering the changes that may happen soon within the tax laws around property investing. So they're always full turnkey. What does that mean? That means that they're complete. turn the key, move in, landscaping, fencing, down to the letterbox and the clothesline, window treatments, floor covering, everything you could possibly think of, stainless steel appliances, etc. Stamp duty savings. Well, on an investment property, and if it's new and you're going to build it, you only pay stamp duty on the land, not on the build. And then there's a reduction in repairs and maintenance as well. So obviously the newer the home, the less maintenance issues you're going to have. There seems to be a rental shortage, and let me just talk to you a little bit about this. I go to some areas in Adelaide, and they have a 0.5% to 1% vacancy rate. What does that mean? That means rental demand is high, which there seems to be a rental shortage, and the reason for that, banks have tightened up, which means that people are finding it hard to get loans. So where are they going to live? They're going to rent. Let me just give you a stat that I found. 70% of all the Australian population own or are buying a home, and 30% rent. That's talking about people who can be a homeowner or at the age where they can rent. 70% are buying or own, 30% rent. 6% of the homeowners, that means 6% of the homeowners are investors, which means the 30% who are renting from the 6% of homeowners that are that have an investment property. So that's pretty incredible. 5% of that 6% own one investment property. So that's pretty amazing. 1% own two, and 0.5% own three or more. So the demand, so people say, will I get a tenant? Absolutely, you'll get a tenant. Gearing a property, what does that mean? Well, let me just give you the definition from the tax department. When the cost associated with owning an investment property exceeds the rental income, this negative cash flow can be used to offset your taxable income. Let me break that down. When the costs associated with owning an investment property. So let's say the costs are $550 a week. What are the costs? Well, you've got your loan costs, you've got your property management costs, you've got your rates, your water, etc. When those costs, so if those costs are $550 a week, and the rent, you say you're getting $350 a week, you got a negative cash flow of $200 a week plus. So that negative cash flow, that $200 a week, can be used to offset other income. So most of our clients are getting about a $30,000 or $40,000 a year tax deduction. They're losses, which means you can offset that against your taxable income. And that means, so if you're $100,000 a year and you're paying $25,000 a year in tax, and now we can get you some tax deductions, which reduces that tax payable to say $15,000 a year, you got a tax saving of $200 a week or $10,000 a year. So now if you're getting $350 a week and you're getting $200 a week from the tax man, and the cost is $550, that property's only costing you $50 a week. I know it sounds complicated, but when we sit down with you, we'll show you how it all works. But the biggest question we have is, do you qualify? So that's where we like to sit down with you, have a look at your situation. Remember, we said that you need to talk to the professionals in these areas to look to see if you qualify. So hopefully you give us a chance. Thanks for listening today, and we're looking forward to catching up to you to do the property investment analysis for you.